Ready to turn your trading game around? Buckle up, as we're about to dive into a strategy that could skyrocket your profits. Don't blink, you won't want to miss this. No time to waste. Let's get the curl trend indicator up on your chart. Alright, now let's dive into its settings and tweak them as needed, just like I'm showing you here. In this approach, think of green dots as cheerleaders for a rising market. So if you're looking to make a long trade, keep an eye out for the red dots. The moment you spot the first green dot on the chart, consider it your green light to enter a long trade. While red dots are flags warning of a falling market. If you're planning a short trade, start by finding a series of green dots on the chart. Then sit tight until the first red dot shows up. That red dot is your cue to make the short trade. But remember, if you choose to depend entirely on this indicator, there might be times when its signals don't align with the main market trend, as you can see in this example. To tackle this, we'll bring in a trend detection indicator. For this strategy, we'll use the 10 and 1 different moving averages indicator as your trend spotting tool. But before we dive in with this indicator, let's tweak it a bit, just like I'm showing you here. In this approach, we gauge the market trend by looking at where the price candles stand in relation to both SMA 100 and EMA 45. If the price candle is perched above both SMA 100 and EMA 45, we consider the market to be on an upward climb. And on the other hand, if the price candle is nestled below both SMA 100 and EMA 45, we tag the market as a downward slide. But if SMA 100 is showing a flat horizontal line and the price is bouncing up and down like a yo-yo, it signals a market that's undecided moving sideways. In such scenarios, we should hold off on confirming any signals. Now, when we mix all these elements together, the rules for entry become crystal clear. For a long trade, we're looking for the dots on the chart to switch from red to green, signaling a change in the market mood. After that, we need to make sure the market is showing signs of an upward trend. Once all these stars align, we're good to go and can jump into the trade. To keep any losses in check, set your stop loss just notch below the recent swing low. Then for balancing risk to reward, think about adopting a 1 to 1.5 ratio strategy. And for a short trade, we're on the lookout for the dots on the chart to flip from green to red, hinting at a shift in the market mood. After that, we need to confirm that the market is on a downward slide. Once all these pieces fall into place, you're all set to dive into the short trade. And to keep a lid on any potential losses, set your stop loss just a smidge above the recent swing high. Then for managing risk-to-reward ratio, think about going with a 1 to 1.5 ratio strategy. Okay, now let's dive into how does a strategy perform during our backtest. Here's the deal. We fired off 100 trades on the gold chart, all in a 15-minute time frame. Out of those 100 trades, this strategy had a winning streak with a 76% win rate. Over a period of 12 weeks, our profits shot out to a whopping 152%. But here's the catch. We pulled off a winning streak of 5 victorious back-to-back. Sure, we had a few bumps with 3 losses in a row. But hey, if you're unsure which indicator TradingView offers is one of the best for money making and trading, don't worry. In this video, I've introduced it to you. So be sure not to miss out on this valuable insight.